Welcome to Brookfield Perspectives. Today we have another edition of Deal Debrief, where we get the download on recent transactions from the people who put them together. On this episode, Matt Hutton from our infrastructure group walks us through the turnaround and successful exit of NGPL, or the Natural Gas Pipeline of America, one of the largest and most geographically diverse long-haul natural gas pipeline systems in North America. Matt, welcome to another episode of Deal Debrief. It's good to have you.
Thanks for having me.
I'd love for you to just tell me a little bit about yourself, how long you've been at Brookfield, and what you do.
Great. I'm a managing partner with Brookfield's infrastructure platform. So in that role, I oversee our investment activities in energy and industrial infrastructure. All in, I've been with Brookfield for about 9 years now. And over that period, I've been fortunate to witness really the substantial growth of our infrastructure platform, which has grown about 6 times from less than 50 billion of assets under management a decade ago to about 320 billion today.
That's quite a number for such a short period of time. In the way Brookfield thinks about infrastructure, what does that platform contain for our firm?
Sure. When we look at infrastructure opportunities, it really encompasses any type of businesses or assets that really have a consistent set of core characteristics. So those are investments that are essential hard assets that provide critical services to society. It's businesses that have high barriers to entry and those that are underpinned by long-term predictable and inflation-protected cash flows. So typically the types of businesses there encompass transportation assets, data and telecom businesses, utilities, as well as energy infrastructure and midstream businesses.
Cool. NGPL falls into that infrastructure platform, right? Can you just give us a breakdown on what NGPL does and how that business has evolved in recent years?
So NGPL, which really is an acronym for the Natural Gas Pipeline of America, it's a long-haul natural gas pipeline system in the U.S. So in that role, it transports natural gas around the country on behalf of customers, which comprise some of the largest utilities, energy producers, power generators, and LNG exporters in the country. It is one of the largest and most geographically diverse systems in North America. It comprises over 9,000 miles of large diameter pipeline and almost 300 billion cubic feet of natural gas storage. And with that, it connects to every major gas producing basin in the U.S. Everything from the Permian Basin to the Marcellus Basin in the Northeast and the Eagle Ford in southern Texas. Maybe just to put that size into a bit of perspective, if the pipeline were stretched out end to end, it would span from New York all the way to Sydney, Australia.
It's like halfway around the world.
It's very large. And on the gas storage side, there's enough gas storage capacity across the system to fit 8,000 Empire State Buildings.
Wow. Is there a way we can conceptualize how much of that gas is being used all the time? What is the run rate of that fuel?
Yeah. So the way to think about it is this system transports about 6% of all gas demand in the US.
So not an insignificant amount. There's a lot of pipelines that are transporting fuels all over the world. This is obviously a very big one. Why were we as Brookfield attracted to this business and specifically to NGPL in particular? How do we evaluate those kinds of opportunities?
Any infrastructure investment has core characteristics: essential hard asset, critical to society, high barriers to entry, and underpinned by long-term predictable inflation-protected cash flows. So pipeline investments, especially NGPL, really check all of the boxes on this one. Now, our history on NGPL, it's quite a storied one. Our original investment goes back to 2009. And at that time, we opportunistically acquired a portfolio of infrastructure assets from Babcock and Brown, which was an Australian asset manager that was on the brink of liquidation. NGPL was a component of that portfolio, and we had a minority interest in the business. In 2015, we then partnered with a strategic partner who also had a minority ownership in NGPL at the time, really to opportunistically recapitalize that business and buy out the minority shareholders, which allowed us to gain full control of the business. And that was really a step change in our investment. we really saw an opportunity to take this control position and reposition the strategy of the business to focus on both growth as well as deleveraging. And that was a strategy that was ultimately successful and culminated in a recent exit.
So I'm curious, obviously coming into this over 15 years ago, were we already gaining some experience in pipeline type operations and businesses, or was this still early days for Brookfield Infrastructure at that time?
One theme that we've seen really over the past couple of decades is we have seen perpetual growth in energy demand, really globally, but also especially so across the US. And part of that step change was with the shale revolution that started in 2008. And that growth in energy demand, we see it continuing today. And we've been a major investor in those types of energy infrastructure businesses, not just natural gas, but our portfolio also spans renewables. It expands into nuclear power as well. And that's a trend as we look forward, we very much expect to continue. Today, just across pipeline and midstream businesses that we manage, it includes pipelines in the US, in Canada, in Mexico, in Brazil, India, and Abu Dhabi. So we have a long storied history of knowing how to manage these businesses in order to create long-term value creation.
What kind of use cases or power frameworks is natural gas used in specifically that might be different from the rest of the energy ecosystem?
Natural gas plays a wider role than what we see other types of traditional sources of energy or sources of power be utilized for. So when you think about natural gas, one component is for electricity through natural gas-fired power plants, which continue to be a very important component of energy demand, especially so in this country. But secondly, gas is used for things like home heating. It's used for industrial processes. But also importantly, in the US, we are one of the major exporters of natural gas through liquefied natural gas, which is a very important component of trade with our allies around the world.
There's many chapters to this book. It's not just one moment in time or one use case.
Many chapters.
Speaking of chapters, we had this relationship with NGPL that really evolved and changed over time through these different phases with the business and different partners. Can you give us a general summary for what ultimately we prioritized in our work with them during that ownership cycle to support this really critical piece of infrastructure?
I think the easiest way to think about our NGPL investment is really in three different phases. In phase one, which I'll call before 2015 recapitalization, there was a time when the business was owned and controlled by 6 separate shareholders, of which we were just one. And with such fragmented ownership, it was challenging to establish consensus and really a clear direction or strategy for the asset. We also saw the business experience some regulatory headwinds, which led to an over-leveraged balance sheet and an unclear deleveraging path, just given the lack of consensus from the shareholders on whether to pursue growth opportunities, which would have ultimately benefited in deleveraging the balance sheet. And that really led to the second phase, which began in 2015. And that was when we saw the opportunity to partner with Kinder Morgan to buy out the other shareholders, to recapitalize the balance sheet, and to increase our respective ownership to about 50% each, which allowed us to take a co-control position and be able to determine the strategy of the business. Now, critically here, by consolidating decision-making and strategy, we were able to leverage our operating expertise to refocus the business really on pursuing highly accretive growth opportunities alongside a very like-minded world-class partner in Kinder Morgan, which resulted in substantial EBITDA growth and deleveraging. And that ultimately led to phase 3, which began in 2021 when we felt like that goal was accomplished as far as implementing our strategy, and we began to opportunistically explore an exit of our investment.
And there was a phase in there once we were really in deep with Kinder Morgan around expansion of the pipeline and some of these other strategic initiatives, some really tangible movements in the business.
That's right. And as far as the opportunity that we saw, it was really around 3 key initiatives. The first was improving the base business. Secondly, was pursuing those highly accretive growth opportunities that you mentioned. And the third was delevering the business. But it was really a combination of all three of those phases that we thought would best create long-term value in this investment for us and ultimately de-risk the investment for our subsequent buyer.
How do we get to this precipice of considering an exit and thinking about this very important handing over of something that we've poured a lot of focus and attention and care into? How do we go about that?
Our strategy was really to put the asset into a de-risked and stable position that would make it a strong and highly desirable investment for our future buyers. So in 2021, we thought this objective was largely achieved. So we began a disciplined and programmatic sell down, just given the size of our stake at that time, which was approaching $2 billion. Ultimately, we sold down our interest via 3 separate patient sale processes in order to maximize value and to attract the widest prospective buyer universe. Our latest sale, which occurred earlier this year, just represents the complete and successful exit of this business. All told, our exit has generated total proceeds of about $1.7 billion, which crystallized an attractive 18% IRR and a 3 times multiple of capital on our investment since that 2015 recap. Typically, for high quality infrastructure investments, the target return level is often in the mid-teens. So we do feel that the successful implementation of this business plan allowed us to outperform what our expectations were when we originally made the investment.
I'm curious, did we learn new things as part of this experience with NGPL, or was this really about seeing something here that we might have seen before and really knowing that we could bring a playbook to this partnership?
First off, what's exciting about our business is we're always learning new things in each of our investments. That being said, we've been around over 100 years. We manage over $1 trillion of AUM. Over that period of time, we've gained a lot of insight on what can go wrong in businesses, but also how to fix it and how to maximize these assets in order to achieve the best long-term value and ultimately a successful outcome. With that, one of the consistent themes is being able to take a very operations-oriented approach into these businesses, but really coupling that with opportunistic and patient capital that leads to successful investment outcomes across different market cycles. Now, oftentimes, our operating expertise is at its highest value when we have control over an asset and the power to make decisions on both the capital and operations-oriented side of the business. We do often see situations where we are acquiring businesses that have had legacy fragmented ownership, and we have the ability to come in a control position and utilize our experience, utilize our hands-on approach in order to best position the business going forward. As an example, we did just announce another large marquee pipeline investment in the US, which is the acquisition of the Colonial Pipeline. That's a business we'll also be acquiring from a fragmented ownership group of 5 selling shareholders. And we think our experience with NGPL does provide a very good reference playbook for the type of opportunities we're likely to see within that business.
It's interesting. I'm hearing you say this is coming at this from both sides. You can't have the operations without some of the balance sheet, and you can't go into a company or a transaction like this and only focus on capital structure or allocation. You have to have it handled from both sides. Has that been your experience in other places too?
That's exactly our experience. You need to have the capital to go in and support the business and ensure that in every capital allocation decision, you're making that decision wearing a hat of what is going to generate the best long-term value in that business and ultimately in your investment. But then at the same time, you need to have an active business plan and value creation plan of how you're going to grow this business and how you're going to continue to de-risk this business over time. We think both are essential in creating long-term value in any of our investments.
That sounds like the definition of the high barrier to entry you were mentioning earlier.
That's right.
Is there something you've learned from this experience with this specific transaction or recently at the firm that's surprised you that you didn't expect from this experience?
One of the positive developments that I think we saw through our NGPL exit, but also we continue to see in the market, is despite the uncertainty that we see in the market today and we see in various different times, quality assets continue to attract investors. So having exit optionality and patience is a critical thing when economic conditions are more unpredictable like they are at the current moment.
Given we spent a lot of time with NGPL across these different phases, as you mentioned, how have we leveraged some of those learnings in some of our other businesses?
When we look at the NGPL business, it spans across the US and touches every major pocket of natural gas demand across North America. Being invested in that business for over 15 years gave us substantial insight into where we were seeing pockets of growth on both the demand side as well as the supply side. Ultimately, that was a key learning that helped underpin a number of subsequent energy infrastructure investments that we made across the continent. That included everything from our investments into US Gulf Coast LNG export, as well as a number of investments we made in Western Canadian gas infrastructure.
So not just where to look, but what to look for, it sounds like.
What to look for and what are the key themes underpinning long-term natural gas demand.
It sounds like there's a lot more out there for us to take a look at, especially as things continue to evolve in this space in particular.
We think there will be.
Great. Well, thanks for your time, Matt. It was great to speak with you. Thanks for coming on today.
Thank you very much.